One of the few financial advisors, Michael Burry, who predicted the financial collapse, worries that the present market chaos may be the beginning of a much worse tragedy. On Thursday, Burry tweeted, "Today I pondered out loud if this might be worse than 2008. The message has since been deleted." Using the term "cover your A," he continued, "What interest rates are doing, exchange rates globally, and central banks seem reactionary and in CYA mode." Hey people, welcome back to our channel. In today's video, we'll be looking at everything you need to know about Michael Burry's warning about the market crash being worse than the previous crashes. But before we start, make sure you subscribe to our channel, turn on the notifications, and most importantly, watch the video to the end. Let's get started. Burry probably meant the Federal Reserve and other central banks who were rapidly boosting rates to tame stubborn inflation. The US dollar has reached record highs versus other foreign currencies, such as the British pound, due to the Fed's aggressive rate hikes, as well as external factors like Russian-Ukraine war and China's ongoing lockdowns. In addition, the Bank of England started a £65 billion bond buying binge this week because the UK's financial stability was being threatened by rising gilt yields. In an effort to support the Chinese currency, the People's Bank of China is apparently getting ready for state-run banks to sell dollars and buy foreign yuan. Rising rates, volatile currencies, and government efforts to control markets and avert economic catastrophes are all apparent warning signs to Burry, who is reminded of the frantic period leading up to the Great Recession. Similar worries have been raised by other academics who warn that an overreacting Fed might cause a severe recession in the US or stagflation, in which inflation rises but growth stagnates and unemployment increases. They have also issued warnings that unstable markets and a decline in public confidence in policymakers could endanger investor and consumer confidence, undermining growth. Burry gained notoriety for correctly predicting and profiting from the burst of the house bubble in the middle of the 2000s. The book and movie The Big Short made reference to his bet. The CEO of Scion Asset Management is also renowned for making last year's bet against Elon Musk's Tesla and Cathie Wood's ARK Innovation Fund, as well as for investing in GameStop before it turned into a meme stock. In addition, he called it the greatest speculative bubble of all time in all things, and predicted it would burst in the mother of all crashes in June of last year. Burry's final tweet on Thursday seemed ominous. On the 14th anniversary of Congress failing to adopt a $700 billion plan to bail out banks reeling from the housing catastrophe, he stated that one of his analysts thought it was spooky to hear him connect the present chaos to the 2008 meltdown. One of the greatest one-day falls in US stock prices ever was caused by the announcement. In a flurry of since-deleted tweets over the weekend, Burry said US stocks still had further to fall compared to current market decline to the start of the dot-com disaster, and predicted many investors would suffer devastating losses. The investor from The Big Short fame tweeted on Friday that 218 companies have their primary stock listed in the US, have a market valuation of over $1 billion, and have annual losses of over $100 million. He noted that 29 of them have market capitalization over $10 billion and are together worth $655 billion. Repeating it, "The absurdity must end," Burry penned. He was nodding in agreement with a tweet from August in which he lamented the return of COVID-era folly in the markets and stressed how such speculation had bloated previous bubbles but always eventually burst them. In a tweet on Saturday, the CEO of Scion Asset Management noted that 13.48% of US equities finished above their 200-day moving average on Friday. He pointed out that this proportion was 1.2% in 2009 at the market's bottom and 2.8% in 2020. He continued, currently at levels from December 2007, indicating that he believes stocks will fall much further before bottoming out. The S&P 500, which is already down nearly 25% this year, may fall another 48% to approximately 1,900 points, according to the prior predictions by Burry. In a tweet on Sunday, Burry said the current market environment reminded him of the second half of 2000 when some underappreciated stocks were trading at steep discounts and high-flying names still had further to fall. Another vibe he was having was that of mid-late 2000. While former momentum stocks are falling, but not far enough, and beloved better businesses still had a ways to fall, free cash flow was completely discounted and ignored. For years, value was poised to soar despite impending crashes. Burry blamed exchange-traded funds and index funds of blindly inflating asset values in a subsequent tweet. He also warned that many investors will be crushed as they all run for the exits, likening the market to a crowded theater. The bubble in passive investment, which has progressively grown over the past 10 years, is what distinguishes the present from the year 2000, he stated. There are so many people in the theaters that the only way anyone can leave is by trampling each other. The door is still only a certain size. Burry is best known for his $1 billion wager against the housing boom in the middle of the 2000s, which was detailed in the book and movie The Big Short. The previous year, he also bet against Elon Musk's Tesla and Cathie Wood's ARK Innovation Fund and bought shares of GameStop before it turned into a meme company. For some time, Scion's CEO had been forecasting a catastrophic market crash. In June of last year, he called attention to the greatest speculative bubble of all time in all things and predicted it would result in the mother of all disasters. Burry said that politicians have no effective solution to avert an impending economic crisis. Burry got to national fame after his wager against the US housing market was documented in The Big Short. What plan can rescue us from this genuine recession? What drives might pull us in this way? Some of us have been anticipating a protracted and severe recession and have provided a thorough justification for why a great stagflation debt crisis is imminent, according to Robini. Burry did not specify the assets he was shorting, but his message was published at a time when rising concerns about a contagion that may harm the whole cryptocurrency industry were raised in response to FTX's abrupt bankruptcy. Burry said, "You have no idea how short I am." Burry claimed in a different tweet that when investors fled volatile digital currencies, gold will reassert itself as the favored store of wealth. The Federal Reserve is currently hiking interest rates at a record clip, quicker than at any other time in recent memory, as the story opens. The present federal funds rate is between 3% and 3.25%, and the FOMC meeting in March will likely price in an extra 1.75 to 2%, taking the rate to close to 5%, which would undoubtedly generate significant turbulence in the market for Treasury bonds. The Federal Reserve also appears unconcerned about domestic inflation and is instead putting all of its efforts into getting it back to the target inflation rate of 2%. Even though supply issues outside the Fed's control may have contributed to inflation, the Fed was urged to stop raising interest rates by the UN as well. Interest rate differences across nations have already had a significant positive impact on the US dollar, boosting it and having an impact on other nations. This presents significant issues since, excluding the United States, the Fed estimates that 50% of the world's GDP is created in nations whose currencies are pegged to the dollar. The USD dominance is also demonstrated by the fact that US dollars account for 60% of all international and currency liabilities and receivables. Additionally, as interest rates increase, it gets more expensive to pay back debt in US dollars, which triggers sovereign debt problems. The movement of Treasury securities is unprecedented. They appear to be dashing up against a wall to unseen levels. With that, the video has come to an end. Let us know what you think in the comment section below to help us expand our community and attract more people who share our interests and are eager to learn. Please hit the like button and subscribe to the channel if you thought the video was interesting. Till then, bye.